can stay. Buongiorno a tutti, buon pomeriggio e benvenuti. Io sono Michele Cerrone e con me ci sono due pezzi da 90 del nostro asset management. Noi abbiamo deciso di parlare di Europa, lo abbiamo deciso tempo fa, qualche mese fa, ma è stata una scelta opportuna. In questi mercati in fibrillazione si guarda con maggiore attenzione all'Europa. Vicino a me, alla mia sinistra, c'è Michael Barakos, che è il gestore dello Europe Equity Plus, fondo azionario europeo, primo percentile su qualunque orizzonte temporale. Primo percentile vuol dire nel miglior 1% per quel che riguarda i fondi azionari europei. E all'estrema sinistra abbiamo Matt Jones. Matt Jones è il gestore del nostro Europe Equity Absolute Alpha, che è un alternativo liquido long short sull'Europa. Quindi affronteremo questo argomento oggi, parleremo di Europa, parleremo di investimento in Europa e opportunità di decorrelazione anche all'interno dell'Europa. Io rivolgerò loro alcune domande, le farò prima in italiano, poi gliele rivolgerò chiaramente in inglese. Comincio da Michael. Michael, perché abbiamo deciso, perché è stata una scelta condivisa, di parlare di azionario europeo in questo momento? Why has JP Morgan decided to talk about European equities now?
Thank you, Michele, and hello everyone. We're really excited to be doing this session. So, one of the major reasons, which has been evident for many years now, is simply valuations. If you look at the left-hand side, we know that Europe versus its history is perhaps in line with long-term averages going back many decades. But most importantly, the elephant in the room is that Europe looks extremely cheap, and it's been getting cheaper and cheaper versus global equities, which is primarily driven by US equities. It doesn't matter which valuation metric you care to choose. You can see that in every sector, Europe has been looking 10 to 60% cheaper than US equities. On average, about 40% cheaper than US equities, which explains some of the substantial outperformance of Europe year to date versus global and versus US equities within that. But it's not just about year to date. You can see that actually, perhaps surprisingly, Europe has been doing very well for a number of years now, not just in absolute spaces, and we've shown you here on the left-hand side a 3-year performance chart going back to when Russia invaded Ukraine, and on the right-hand side a 5-year performance chart going back to the outbreak of the awful global pandemic. And you can see over 3 years, European beta has actually outperformed US beta, just at the passive level. I think that surprises people. And over both 3 and 5 years, active management can add a lot of value on top of that. So the JP Morgan Europe Equity Plus Fund that we'll be discussing today has delivered substantial performance in addition to both the Europe and the US indices over both 3 and 5 years.
Beh, io direi di continuare. In questo momento tutti poniamo l'attenzione a Trump, è cominciata l'era di Trump, e per quello che riguarda anche tutte le tensioni geopolitiche globali di cui noi leggiamo ogni giorno sui giornali, come queste secondo te stanno influenzando il mercato europeo? What about the global geopolitical tensions that we are reading about in the news every day, and how are they affecting the European stock market, Michael?
Yeah, I mean, there's no doubt that throughout my career at JP Morgan Asset Management doing European equities since 1999 now, so quite a long time, we've benefited globally at the economic level, at the market level, from globalization over the 80s, over the 90s, over the noughties, over the 2010s. There's no debate about that, theoretically or empirically. What's interesting is that from here, I think you're clearly getting deglobalization, and that's been going on for a while. This isn't just something that's happening under the new Trump administration, and I think it will go on for decades, not just years. So that is a headwind to global markets. It's particularly as you point out, Michele, a headwind to European markets because particularly in the case of the tariffs being imposed by Trump, Europe is a very open economy in aggregate, very open market, and you can see that the European Union is about 20% of US imports. So there's no getting away from that. That's a headwind. But a lot of that headwind was played out in the fourth quarter of last year in terms of market performance. And actually a lot was already in prices, which explains the year-to-date, surprising for many people, significant outperformance of European equities. The other big risk we're grappling with is the defense situation. There's no doubt that Europe underinvested in defense for decades, relying on the US being the policeman of the world. You've seen in the last decade the EU have increased defense spend by about 50%, and there's no doubt that that will increase further. I think you're going to see that stabilize at 3 to 5%. You've seen the UK say 3% by 2030. You've seen Germany announce as much as 10% of GDP on defense spend. So these are going to be headwinds to Europe. The silver lining, of course, is a lot of this defense spend will go on European defense companies.
Michael, tu hai menzionato che le valutazioni attualmente sono relativamente attraenti per le azioni europee e che i rischi politici in questo momento sono gestibili. Ma secondo te quali sono i catalizzatori a livello macroeconomico che possono continuare a guidare le performance dei mercati azionari europei quest'anno? You mentioned valuations being relatively attractive for European equities and geopolitical risk being manageable. What are the catalysts at the macroeconomic level that can continue to drive performance in 2025 for the European stock market?
Yes, I mean, it's a good question. A lot of the catalysts that we were excited about coming into this year are literally playing out in front of our eyes every day and every week and every month this year. So we can start with the news overnight. You saw the meeting in Saudi Arabia where Ukraine and the US got together, proposed a one-month ceasefire. That's going to go to Russia to opine on, but there's no doubt that all parties want to bring a ceasefire into place. I've shown you just how well European equities have done, despite the negative headlines 3 years ago. But look at the right-hand side of this chart. Even though energy prices have come down significantly from those peaks 3 years ago when the conflict broke out, European consumers, European industrials are still paying 3 to 4 times what US consumers and US industrials are paying for energy, to heat their houses in the case of consumers, to run manufacturing in their factories in the case of industrials. And I think if you see a ceasefire, which is very likely, I think, in the foreseeable future, I don't think they're going to equalize because the US is self-sustainable in energy and Europe isn't, but you'll see that gap come down further. And that will be a key driver for industrial margins in Europe and for consumer spending power in Europe. Remember, the consumer is 2/3 of the economy. Look on the left-hand side as well. The European consumer is a lot more conservative versus the US consumer. I think still scarred from the GFC, the Eurozone crisis. A lot of excess savings from the pandemic fiscal stimulus 5 years ago haven't been spent yet. If the European consumer can get a bit more confident, if we can start having some positive headlines rather than just negative headlines, that can be a very powerful stimulus. Another very powerful stimulus that's been playing out in the last 10 days is Germany. Germany is the only developed market where sovereign debt to GDP on the right-hand side has actually come down in the last 10 years from 75% to 60% of GDP. So the arguments we're making is there's a lot of firepower available to it to leverage up again, as opposed to what's happening in the US, where it's gone from 90% to 110%. And that's playing out. I mentioned defense spend, 10% of GDP. They announced in recent days infrastructure spend, spent on infrastructure aging in Germany, being as much as 10 to 12% of GDP. These are massive numbers. You know, Germany has been the sick man of Europe for the last few years with no growth. So the rate of change of expectations here are monumental for the market and are only just beginning. And in addition, beyond Germany, in the south of Europe and in Ireland, you have a lot of stimulus that was legislated on 5 years ago with the EU Recovery Fund. But as you can see by the purple bars, in 2025, this year, and 2026, will only actually get distributed now. And that will be a big boost to the economies, as I said, in Southern Europe. In Italy and Spain, which are big economies, 3 to 5% of cumulative GDP. In Greece and Portugal, smaller economies, could be as much as 5 to 8% of GDP cumulative. So these are big fiscal tailwinds that are playing out. And that's not forgetting, last but not least, the monetary easing and the monetary stimulus that's playing out in Europe, as opposed to what's happening again in the US. The ECB has got inflation back under control, headline and underlying inflation on the left-hand side at about 2%. The game isn't won, we still need to be vigilant, but that's their mandate for price stability. And you can see the ECB has led the Fed in terms of rate cuts starting last summer. With the 25 basis point rate cut last week, that's 125 basis points cumulative so far since last summer. And I think the market's right on this one, expecting a further 75 basis points cumulative by the end of this year. That's going to be hugely stimulative for European corporates, particularly further down the market cap spectrum that rely almost solely on bank lending, which is really geared into ECB rates at the short end of the curve. So a number of exciting, to be honest with you, the most exciting catalysts I've seen as a European equity manager for over a decade that are playing into the economy in Europe and playing into European market performance more importantly.
Thanks. Noi basiamo sempre la gestione dei nostri fondi azionari sullo studio delle singole aziende, sull'analisi delle società. Michael, per il momento l'ultima domanda, last question for now. Cosa stai vedendo tu a livello aziendale? Cioè come sono i fondamentali delle aziende europee e se continuano a migliorare come è stato nell'ultimo periodo? What are you seeing at the company level, Michael? How strong are corporate fundamentals and are they continuing to improve?
Yeah, I mean, I've spoken just about the top-down macro case for Europe, but bottom-up, things haven't looked this good for many years. I think firstly, and this is very new information year to date, you're seeing after over a year of earnings downgrades for European corporates, you're seeing Europe now being the only region in the world, as you can see from the line that we've circled, with earnings upgrades year to date. All the other regions of the world seeing earnings downgrades. That's a really important change year to date that again helps to explain the strong performance of European equities and gives credibility to the growth rate in earnings that we're seeing. So one of the many reasons why Europe underperformed the US significantly last year was lack of earnings growth. Look at the right-hand side, the green chart. This year, we expect earnings to grow in Europe by 10% versus 12% in the US, so much closer in line. But that European number is getting upgraded, so it's very credible. That US number is getting downgraded. And again, you will have all seen the profit warnings, consumer-related, coming out of the US in the last 24 hours. And finally, beyond the corporate sector that looks very strong, let's not forget the financial sector in Europe. Still very much scarred by what happened during the Eurozone crisis, but financials in Europe, particularly banks, but also insurers, are very different beasts today. And it's not a coincidence that European banks have significantly outperformed the Mag 7 since the Pfizer vaccine news in late 2020. Again, I think quite surprising for investors because on the right-hand side, the returns on equity generated by these banks have gone from nothing 5 years ago to now being higher than US banks. So it's not just European corporates that are improving and looking strong, but the European financial system as well.
Thanks, Michael. We come back to you very soon. Now, passiamo a Matt. Matt è il gestore, come dicevo, del nostro Europe Equity Absolute Alpha. Cerchiamo di approfondire il fondo che gestisci, Matt. Puoi spiegarci gli obiettivi di un fondo come lo Europe Equity Absolute Alpha? Let's delve into the fund you manage, Matt. Can you explain the objectives behind a fund like the European Equity Absolute Alpha?
Europe Equity Absolute Alpha is a daily liquidity market-neutral hedge fund. So what we're doing here is we're going long the stocks that look attractive on our investment process, whilst at the same time shorting those that look unattractive and trying to generate a positive return regardless of market environment. So we're taking no market exposure, just really focusing on that bottom-up stock-specific alpha. And in terms of objectives, well, the first is strong risk-adjusted returns. So the fund has a targeted volatility range of 5 to 8%. We're very disciplined in using the gross exposure to keep volatility in that 5 to 8% range. The second objective is generating returns that are uncorrelated to traditional asset classes. So this fund has a realized beta versus European markets of negative 0.02. So it really is a genuine alternative and a genuine diversifier. 2022 was the perfect example of that. So in a year where we saw European equities and bonds down double-digit percentage points, this fund was actually up 8% net of fees. And finally, we're looking to generate returns through alpha and not beta. So we're not moving the fund's market exposure around. We're not looking to time the market. We're focusing on bottom-up stock-specific alpha. And you can see on this slide that over 90% of the fund's realized return since inception has come from that bottom-up alpha. We are market neutral, not net neutral. We're happy running a little bit of net exposure to balance out the beta of our longs versus shorts. Our longs tend to be a little bit riskier on average than our shorts tend to be a little bit riskier on average than our longs. So we tend to run a small net exposure of anywhere between 0 and 20%. Very much not a call on the market, not us trying to take beta and sell it as alpha, but really to hedge out that market exposure. And what really appeals to a number of clients as well is the fact that the alpha in this fund is coming both from longs and shorts. We have a very powerful investment process that is symmetrical. We can take everything we look for on the long side, flip it over, and it's a really great way to find shorts. And that actually means that our shorts work even harder for us. They don't just hedge out the market exposure, but they actually make return in their own right.
Thanks. In che cosa si differenzia lo European Equity Absolute Alpha rispetto all'Equity Plus? E io dico plus, lo ripeto sempre perché viene dal latino, quindi I don't like to say plus because it's Latin. So just to justify. Tu e Michael vi consultate sulle decisioni da prendere nei portafogli. How is this fund different to Europe Equity Plus? And do you and Michael consult on decisions?
Yeah, so that's a really good question. So there's a lot of commonality between the two funds. So they share an investment process. Indeed, they share portfolio managers as well. So my two co-portfolio managers on Europe Equity Absolute Alpha, Nick Horn and Ben Stapley, are also named on Europe Equity Plus. And yeah, day to day, we all sit together. We're part of the same investment team. So there are very regular discussions. Ultimately, both funds are using the same investment process, which is on this slide. So on the long side, we're looking for attractively valued, high-quality companies with improving fundamentals. And as I said, the shorts are exactly the opposite of that. So looking for expensive companies that are low quality and also seeing deteriorating trends. And this is an investment process that is rooted in behavioral finance theory. We've been running some form of it for about 30 years as a team. And you can see here very strong backing in empirical data. So looking just at some of the quantitative signals that go into our process, here we have the performance through time. And you can see very strong outperformance of the best stocks, that Q1, but also underperformance of the worst stocks, that quintile 5. So the difference between the two funds really comes down just to portfolio construction. Europe Equity Plus is an active extension 1-30-30 fund. So we're going around 130% long, 30% short. So you've got 160% gross exposure to the investment process, but only 100% net exposure to the market. So it's a beta 1 fund that should be evaluated versus MSCI Europe. Europe Equity Absolute Alpha, on the other hand, is a market-neutral fund. So we have a cash benchmark. We're looking to generate positive returns regardless of what the market does, and the long and short exposures are much more balanced.
Oh, thanks. Vediamo un attimo quelle che sono le performance storiche del fondo long short, sia in termini di rendimento assoluto che in termini di rischio, e come questo si confronta con altri fondi simili e col mercato in generale. Questa domanda la faccio soprattutto per il fatto che spesso mi capita di presentarlo il fondo, mi è capitato di parlare del fondo e di trovare interlocutori che dicevano «Oh, ma io un long short l'ho comprato 15-20 anni fa, sono rimasto deluso, questa roba non la voglio più vedere». What are the historical performances on the long short fund, Matt, both in terms of absolute return and risk, and how do they compare with other similar funds and the market in general? I ask this because sometimes when I talk about the fund, there are interlocutors who have had negative experiences in the past with this type of strategies.
Of course. So manager selection is very important when you're assessing any active manager. But I think it's particularly important when you're looking at the absolute return space, because there's a very, very wide dispersion of outcomes, as you alluded to. So that's why we're very, very pleased with the returns that we've generated in this fund. So if we look at the absolute returns, I should say as well, this fund has a track record going back to the end of 2013. So we've seen a lot of different market environments. We've seen a lot of different regimes. We've certainly had a lot of volatility shocks. And you can see as well, the portfolio management team, myself, Ben, and Nick, all have spent our entire careers at JP Morgan and indeed have all been involved in this fund since inception. Nick's actually been formally named on this fund since inception. So we really own this track record as well. And we're very pleased with having generated 5.7% in excess of cash over the life of this fund, annualized, and that's net of C share class fees. And we've done that with a volatility of around 6. So an overall Sharpe ratio of 0.95 net of fees, which we're very, very pleased with. And as well as that, just on an absolute basis, we're very proud of how these returns stack up versus our competition. So we are 10th percentile since inception versus our Morningstar absolute return peer group. And indeed, these returns are similar to what you would have had in the MSCI Europe over the same time span, but with much less volatility, crucially. And you can see that realized beta and realized correlation at the bottom of this slide, both around 0, really demonstrating that absolute return nature of the fund. And in terms of our competitive positioning and how well we are doing versus peers, you don't just need to take my word for it. We just won the Best UCITS Equity Strategy at 2024's Euro Hedge Awards in London last week. So very, very... Oh. Thank you. I wasn't angling for applause, but I will take it. So thank you very much.
Ultima domanda per Matt per il momento. Come può essere posizionato questo fondo, l'Absolute Alpha, all'interno di un portafoglio? Matt, how can the Europe Equity Absolute Alpha be positioned within a portfolio? What do you think?
So I think the key characteristics about Europe Equity Absolute Alpha that make it incredibly powerful from a portfolio perspective, put the strong risk-adjusted returns to one side, it's when you combine those with the lack of correlation with equities and bonds that it gets really interesting. That isn't always what you get when you invest in an absolute return or a hedge fund. So you can see on the left-hand side, Europe Equity Absolute Alpha has had a very low correlation since inception with European, but also crucially global, equity and bond markets. Near zero in all the cases, and that's not necessarily the case when you look at how the hedge fund HFRX, equity hedge index, or equity market neutral index has moved. And indeed, it's when you combine those strong risk-adjusted returns with that diversification benefit that you really see the power of allocating to Europe Equity Absolute Alpha. So on the right-hand side, we've taken the long-term capital markets assumptions produced by JP Morgan. We've taken what they expect the equity and bond return, but also volatility will be over the next 10 years. And then we've looked at the effect of allocating a little bit of a 60-40 portfolio. What if you added a little bit of EEAA into that portfolio? And you can see that not only do you reduce your expected volatility, given the diversification benefit, but also, given some of the question marks around the outlook for beta that we see going forward, and I should say as well, this is global markets. So again, if you think there is a headwind from potentially the US starting to slow down, some of that valuation premium unwinding, then actually introducing something like EEAA, which can produce strong risk-adjusted returns in its own right, can actually give you a bit of a free lunch, both reducing risk and increasing expected return. But obviously, when diversification is really powerful is when things are challenged, when markets are going down. So that's why I think these next two slides are so persuasive. So on the left-hand side of this slide, you have the 10 worst months for MSCI Europe since the inception of this strategy at the end of 2013. On average, in those months, the market was down 7%. This fund actually up 10 bips net of fees. So again, really illustrating that diversification benefit. And this is for equities, exactly the same true for bonds, even better here. So it really is a diversifier from not just your equities exposure, but also bonds. Here, in the 10 worst months for bonds since inception, the strategy was up in 9 of those months with an average net of C share class fee returns of 70 bips.
Oh, thanks. Come back to Michael. Michael, tu ci hai mostrato l'eccellente performance di Europe Equity Plus negli ultimi 3-5 anni, sia rispetto all'MSCI Europe che rispetto all'S&P 500. Quali sono i vantaggi di questo tipo di strategia, le strategie Active Extension 130-30, rispetto a quelle più tradizionali nello spazio beta 1? E cosa ti ha aiutato a generare questa performance eccellente costantemente? You have shown us the strong performance of Europe Equity Plus over the past 3 and 5 years, both versus MSCI Europe and versus the S&P 500. What are the advantages of active extensions 130-30 strategies over more traditional long-only strategies in the beta 1 space that have helped you generate this consistently strong performance?
Yes, a very good question. So we've been running long-only strategies very successfully since I joined in 1999, and we have some fantastic long-only track records. But if I only had one way to run beta 1 money, net 100%, measured against the MSCI Europe Index, measured against, for instance, the Morningstar Large Cap Blend Index, it would be an active extension 130-30 strategy. And there are 3 main reasons for that. So you can see them in the top left-hand side. Firstly, as Matt said earlier, for every 100 euros you're investing in this strategy, you're getting your money to work harder for you. You're getting about 160 euros of gross exposure, 130 on the long, funded incrementally by the 30 on the short. Secondly, by relaxing that shorting constraint just a little bit, we only go short typically about 30% of the portfolio, so it's not a big shorting constraint. A little bit of shorting can go a very long way to generate incremental alpha. So think about it for a second. The short book is 30% typically of 160% gross exposure, so about 20% of the gross exposure. If I show you the next slide, the blue bars are the return statement of fact from this strategy over all time periods, all the way back to inception 18 years ago. They are pretty impressive returns, I would say, net of fees. So these would be good enough to put you top decile versus the Morningstar large cap blend peer group over every time period. But look at the yellow bars. These are the returns from shorting. It's only 20% of the gross exposure budget, remember, and yet it's almost as good as the returns from going long. So we're, if anything, even better at shorting than we are at the long side of things, particularly because we can focus right at the extremes. So all of a sudden, the green bars are the total return you get as an investor, almost double the blue bars, and that's good enough to put you top percentile over 1 year, over 3 year, and since inception. And then going back to the previous slide, the third main reason why I think this is superior to a long-only fund is that you're getting the best of both worlds. You're getting that unconstrained alpha profile, top percentile over 1 and 3 years, top percentile probably more importantly over 18 years, but you're doing it in a very risk-constrained way. People can get scared when they hear about shorting because shorting can be abused in the marketplace. But if you use a little bit of shorting responsibly, not only does it boost your alpha, but it can actually be used to bring in risks, not take out risks, bring in risks. The only risk you're taking out here is the risk to the investment philosophy statement that Matt touched on. We can actually use it to more successfully bring in risks, particularly the top-down binary risks. We like to be roughly sector neutral, roughly country neutral, roughly beta 1, net 100 invested versus the MSCI Europe benchmark. But also, for instance, size would be a great example. We passionately believe structurally there are huge anomalies within small and mid-cap space. Cyclically, at this moment in time, they're off the chart. But as a long-only manager, even if you believe in that and you believe you can generate alpha from that space, you have to take a bit of a structural size bet towards SMID. And we know that small and mid-cap has underperformed year after year after year for a decade. But in this strategy, you can go long small and mid-cap, but equally, you can go short small and mid-cap as well to exploit the anomalies of the small and mid-cap stocks you think are going to go to zero. And hence, when you hedge that off, you don't need to have any size risk whatsoever. And that's the case on this strategy.
Vorrei giusto rafforzare il concetto che Michael ha appena espresso, laddove chiaramente la costruzione di un fondo azionario sia basata principalmente, e nel nostro caso lo è, sull'analisi dei singoli titoli. Nel momento in cui si analizzano i titoli, ci sono titoli che si guarda con estremo favore, ma i titoli che vengono normalmente da un gestore normale accantonati, messi da parte perché sono ritenuti sopravvalutati. Il vantaggio della strategia Active Extension che utilizza lo Europe Equity Plus è proprio quella di sfruttare anche la seconda parte dell'analisi, quella negativa, e di ampliare quella positiva, quindi di creare potenzialmente più rendimento, cosa che è nella storia del fondo, attraverso questo meccanismo di gestione. Passo a Matt. Michael ha menzionato che ci sono diverse tendenze geopolitiche che chiaramente stanno influenzando l'Europa in questo momento. Come gestisci i rischi macroeconomici nei tuoi portafogli in questa fase? Michael has mentioned that there are a number of geopolitical risks impacting Europe right now. How do you manage the macroeconomic risk in your portfolio?
Yeah, that's a really good question. So we think our edge is in bottom-up stock selection. That's where our investment philosophy focuses. That's where we think we really have an insight. But of course, bottom-up stock selection and the outcomes from that are influenced by the top-down macroeconomic events. Just take a look at what's happening at the moment. So it's really, really valuable to have tools at our fingertips that enable us to take a look at the portfolio top-down and slice risks in a number of different ways. So here we have an example of our proprietary risk dashboard built for us by our quantitative research team, developed in-house, and joined up exactly with our holdings, with the way that we see the world, so our quantitative data, all living in one place. And the benefit of having something that's been built internally is it can be very, very responsive. We don't need to wait for a third party to react. Often the biggest macroeconomic shocks, the most important things, are things that 6 months ago weren't even on your radar. look at COVID-19, for example, in 2020, within 3 weeks, we had a factor in our dashboard that would basically say, what is our portfolio's exposure to COVID-19? You know, if there is positive vaccine sentiment, what does that mean for our returns? And that's exactly the same way that we approach risk on an ongoing basis. So we have factors in there for Chinese economic growth, for example. Of course, the main thing at the moment, which we're relying very heavily on, is US tariff policy. You know, we're comfortable taking a little bit of a risk, we're comfortable having a view, but we want that risk to be intended, and we want it to be proportionate. You know, in both of these funds, we want ultimately returns to be driven by bottom-up stock selection, not any incidental risk, whether that be macroeconomic or, as Michael alluded to, sector, country, you know, size, for example. We really think that the way you maximize your risk-adjusted returns is being very deliberate in the risks that you're taking.
Prima di venire all'ultima domanda per entrambi, voglio fargli una domanda che ho ricevuto personalmente molte volte in questi giorni e non solo in questi giorni. Si parla di difesa europea, quindi molti chiedono informazioni riguardo investimenti funzionali all'aumento della spesa che avremo probabilmente in Europa per la difesa. Before the last questions, I want to ask you, do we own any stocks related to the military defense in Europe right now?
Yes, so this is something that we've been looking at a lot over the last few years. Obviously, interest in defense has become even more paramount this year, but it's been a theme that has been percolating for quite a while. And again, coming down to our stock selection approach, we haven't been looking for stocks ultimately where we're seeing that theme come through in the fundamentals. So where are we seeing companies that are already reporting significantly better earnings thanks to this defense demand? So names like Rolls-Royce, which is a British aircraft engine manufacturer, heavily geared into military spend thanks to its work on the engines that go into fighter jets. We have the UK company Babcock. They're a defense contractor that work on the UK's nuclear submarines. And more recently, we've been looking at Thales, the French company that does a variety of different defense exposed projects, from cybersecurity all the way through to some of the air defense missiles.
Veniamo all'ultima domanda per entrambi. Michael, ti lascio 3 minuti per dirci perché dovrebbero comprarsi Europe Equity Plus. Michael, why should they buy Europe Equity Plus in 3 minutes?
Sure, I'll give it a go. Well, very much like Matt said earlier with the summary slide for Europe Equity Absolute Alpha, this is a strategy that's been going for a long period of time, for 18 years. And importantly, the portfolio managers are not only experienced, because it's very easy to find experience in the marketplace, they are very stable. So these are the same portfolio managers that have been involved in running the strategy for 18 years. I've actually personally been named on it since inception 18 years ago. I think that's a very important starting point, because it means the track record that we're talking about, those top percentile returns over 1 year, over 3 years, more importantly over 18 years, are still credible, because we're not planning on going anywhere. We passionately love where we're working. We love the team that we're working with. We have fantastic culture, and we're looking to replicate those returns going forward. If we go more broadly, I think there's a number of other points to make. We've delivered very consistent returns as well. It's not been down to one particular year. So much so that 10 of the last 16 calendar years have been not just top quartile returns, but top decile returns, as evidenced by those gold medals. So that's a hit rate of over 60% of calendar years' top decile returns. And it tends to be in regimes. So 08, for instance, was the first full calendar year we had. You'll all remember 08 being the global financial crisis, Lehman Brothers. That was a very tough year for us. We had a bad starting year. But again, being JP Morgan, taking a long-term view, believing in what we're doing, we stuck with it. The next 7 years in a row, top decile returns each and every year. We had a bit of a lull, one top quartile year, but also one bottom quartile year in 2020. It was actually a bottom decile year in 2020, but we stuck with what we know we're doing, kept on looking at the long term. In 21, we were top percentile, and in 21, 22, and 24, we've been top decile again. And again, the year to date has started very well. So it tends to work in regimes. When you have that kind of consistency, not only your top percentile since inception, but for over 90% of the time since inception, we've been either 4 or 5-star rated by Morningstar, which is based purely objectively on risk-adjusted returns. And also, this works in various market conditions. So look at the bottom left. Whether you're talking about up markets or down markets, whether you're talking about growth markets, we've delivered outperformance roughly 2/3 of the time. And then in value markets, that outperformance increases even further to roughly 3/4 of the time. The final point I'll make is on the bottom right-hand side of the slide. Again, you're not relying on a portfolio management team that are particularly insightful or capable within a particular super sector. We've been able to add alpha generation in every single super sector without exception since inception, both on the long side and on the short side, as evidenced by the bottom right-hand side chart. The only debate has been how much alpha we've been able to add on average each year. So again, that should give you confidence that these returns are repeatable and the insights that we have are across the marketplace. They're not reliant on certain sectors doing particularly well or particularly badly.
Grazie Michael. Faccio la stessa domanda finale anche a Matt. Perché comprare Europe Equity Absolute Alpha? Matt, why they have to buy Europe Equity Absolute Alpha?
So it really comes down to those 3 key objectives I spoke about in the fund when I started speaking and how we've delivered on those. So the first is that strong risk-adjusted returns. As I said, 5.7% over cash since inception, a Sharpe ratio of 0.95, and also returns that are very, very competitive versus the street. 10th percentile, since inception, comfortably top decile over 1, 3, and 5 years. But as well as that, it's the power of diversification. So it's that focus on bottom-up, stock-specific alpha, and the resulting low correlation with not just equities, but also bonds. And when you combine that diversification benefit with the strong risk-adjusted returns, it basically means that Europe Equity Absolute Alpha is an insurance policy against any beta weakness, but actually one that you get paid for taking out.
Io direi, nel ringraziare sia Matt che Michael per il loro intervento qui, ringrazio anche tutti voi. Vi invito nel caso a venire al nostro desk giù se volete chiaramente ulteriori informazioni su questi 2 fondi o altro, e buon lavoro a tutti. Grazie.